And according to YouGov, a big deal.
From YouGov, which is a serious polling site.
The latest polling projection from YouGov.
The CBS YouGov poll.
YouGov.
As you can tell, we're going to be talking about the market research company YouGov. I'm going to break the company down, talk about what they do, discuss their financial history and my expectations for their future. Then I'm going to make three different discounted cash flow models. I'll do a conservative one, a base case one, a middle ground one, and then a hopeful future one. Even my most conservative case, I'm predicting the value of this stock to double, to go up 124% to be precise. My base case is more like 4x, and my admittedly ambitious hopeful case predicts a 10x return. Okay, what does the company do? They run panels. Pretty much they ask thousands of people thousands of questions every day, and they get data back. I think of this as their raw material. They then take that raw material, package up the information for that, information about people, brands, or just some interesting event. Pretty much anything. More specifically, anything someone's willing to pay for. They will package it and they'll sell it. They segment their company into three different parts. I find it useful to further divide it into two parts, passive and managed. In the passive section, I put their segment of data products. Now, data products is where they have taken all that information, packaged it into useful information about whatever. Now, this is not a paid endorsement, but I do recommend their newsletter. You'll find fascinating polls and information. They release a lot of these headline figures free to anyone. But of course, companies, they don't want just the headline figure. They want the raw data behind it all. And for a set fee or for a subscription model, they get access to it. All that adds up to a revenue of about £84 million. And it's quite a passive model. Once you've gathered all this information, you can sell this for years and years at a time. Margins are quite good. They're up at about 32%. Next up, we have their shopper segment. Now, this has been heavily influenced by a recent acquisition, which I'll talk a little more about later. I think that this is very similar to data products with a lot more focus on retail, what people are buying and selling in shop. In fact, where they get their data even changes due to their recent acquisition. People can scan receipts to send them information about this. So if you're selling a new product in a supermarket, this is the segment you'd probably want to subscribe to get their information. The revenue adds up to about 128 million. Margins I have here at 25%. They've taken a bit of a hit in the last year due to the acquisition. So I expect that to be ironed out and this to get up closer to 30% going forward. These margins are the main reason I've put data products and shopper together. In managed, we have research. This is their bespoke model. If you can't find the answer you needed neatly packaged up in data products, if it's something a bit more niche you want an answer to, you go here. You call YouGov, you tell them your issue. They put a team of people on to answer your problem. They look through their own data, of course, first, but much more likely they run a new survey, many surveys. They package all that information in a nice report for you. That adds up to be their biggest revenue segment. Their revenue is up around 200 million. But if people are involved, that means lower margins. Their margins are quite stable at around 11%. While it's the biggest in revenue terms, with those low margins, it's probably not the biggest in profit terms. And I certainly don't see it as the biggest potentially. Because the two passive ones, they can scale. You will not need to add much more investment into them to get more money. Those margins can in fact increase. The bespoke model, if twice the number of customers want questions answered, first of all, they probably wouldn't have the staff to answer it, so they'd have to turn a lot of that business away. If they could double their staff though, the margins would stay the same. Okay, that's what the company does. How about what the stock price is doing? As you can see from the last 5 years, it's been doing pretty terrible. If we zoom out to 20 years, it's a little bit of a different picture. Ever since 2008, it's generally done pretty great. You can see a hiccup there in COVID, but after COVID, it exploded up. It wasn't until about 2022 that it started to fall, along with pretty much everyone else in the market. The issue for YouGov is, unlike everyone else, it never rebounded in 2023. It continued to fall. Now, one of the reasons for that fall is in early 2023, the co-founder and longtime CEO, Stephen Shakespeare, stood down. He was replaced by the CEO, Steve Hatch. Now, to put it mildly, his tenure did not go well. He was accused of operational missteps, bad forecasting, whatever the reason. And honestly, I wish the companies would come out and say what they think sometimes. It's always very polite. But for whatever reason, investors called for his head. They wanted him out, and he was replaced in early 2025. The obvious choice as a replacement was the return of Stephen Shakespeare. He's come back on an interim basis, but he has indicated he's here for the full transition into AI. So I read that as 2 to 5 years going forward. He should be here for the difficult times, as it were. Now, the real question for me is, was it a bad CEO that caused this downturn, or is there something structurally wrong in YouGov? If we look at the last 10 years of growth numbers, they look fantastic. They are fantastic. Consistent double-digit organic growth numbers. That is until the last 2 years. They look great. They're not real. There was actually 0% or near 0% organic growth the last 2 years. This is purely due to their acquisition of GfK's consumer panel services. That has inflated their shopper segment, and it has made it look like there's been decent growth. But that's the past. Let's think about the future. To think about the future, though, I'm going to go into the past. In 2023, they had their most recent investor day. They talked about a medium-term revenue figure of 500 million and a margin of 25%. Now, the valid question is, are these goals still valid after 2 years of stagnation and changes in CEO? On the most recent earnings call, Shakespeare did indicate that these are still the goals of the company, which is fantastic because they are still thinking growth. They're not thinking to maintain this stagnation that has beset the company the last 2 years. So let me talk about potentially how they could get back to a growth level that we have seen previously. First thing to note is maybe they don't have to change anything. It is possible that this last few years, a normal cool down after COVID, and then a hiccup with some poor decisions from a CEO. If they get back to the old company they were, the growth could potentially return. And remember, they are in a growing market. I have research here from the business research company that predicts the research market to grow a 4.5% CAGR going forward. And remember, YouGov are a small and historically speaking a growth company. There's no reason to believe that they cannot grow more than this. They can gain market share. In fact, at the recent earnings call, Shakespeare made quite an impassioned speech for their right to fight for this revenue, to fight for market share from these other companies on the back of their quite impressive proprietary panel system, where they have like over 27 million panelists signed up. I also think there's a great case for innovation here when it comes to AI. They're not going to build AI, but they can and hopefully will make use of it. Think of the gold standard in a panel. That would be a person asking another person questions, adjusting their questions as they get answers in. YouGov currently don't do that. They play a numbers game. They ask millions of people, millions of questions, sort through the data. With AI, slowly at first, you could start adjusting the questions people are asked based on some of their answers. Get much more detailed data. Really improve their data. That could be a growth factor for this company. So I really think there's a case for growth here, whether it's just the general market growth or they can actually gain market share off other people or through some sort of AI innovation. There is a case here. Now, I do want to talk about margins at this point. They've taken a bit of a hit, not too much of one, but a bit of a hit in the last year or two. That's with their slowdown. They're set up as a growth company, so a slowdown would hurt margins. And then also they've had an acquisition which has left a little hiccup in their margins. With that said, they are in their latest report, they were back to about 16% margins, and they're in the middle of cutting some spending. So they should be able to improve those margins up to maybe back up to 20%. They've talked about doing a investor day in the very near future. I'm interested in hearing what they have to say. I want to hear what they have to say about their growth potential, and I want to hear what they have to say about margins. Now, I think I was getting a little too rosy there, so let's pull it back a bit as I talk about the first of my 3 valuation models. It's going to be my conservative model. I'm predicting 3% growth in the next 12 months, and I have that growing over the next 4 years till it gets up to 5% growth and then falling back down to a 4% growth. You should note here that 4% is less than the market is predicted to grow into the future. So this is somewhat conservative. Margins currently at around 16%, but that doesn't take into account the financial expenses that are quite high at the moment due to their latest acquisition. But I have that falling over the next 9 years or so down to a 16.5% margin going forward. Tax rate, it's currently around 27%, but I'll predict that to go up slightly because none of us know the future. And then I have a return on invested capital of 15%. Putting all those numbers together, the discount rate, I'll start off at 9% and have that fall back to a more historical 8%. Putting all that into a model, and we get a valuation of about £5.50, which is over double the current price. It's 124% upside from here. That's the conservative model, and I am predicting a doubling of price. This is why I'm quite excited about this company. Next, let's look at my medium case here. This is the case that I guess I'm betting on, as it were. Once again, I'm going to go with growth of just 3% for the next 12 months, but then I'm going to have it rise significantly up to 8%. Still a lot less than their historic double-digit growth numbers, but I think quite reasonable. And then for a terminal rate, we'll go with the general market sentiment of 4.5%. Margins, this is where we're going to get up a good bit. Currently at around 16%, so I'll have their cost-cutting effects really coming into play and giving them a good number this year. That number is probably a bit high now that I look at it, but I do think they can improve that over the next 4 years and 9 years, get it closer to about 20%. Remember, one of their medium-term goals is 25%. I don't think it's necessarily unreasonable to hope for 20% here, especially as they grow those passive parts of their business, which have margins up near 30%. Tax rate, I'll leave the same, and discount rate, I'll leave the same. Return on invested capital, though, we'll bump that up to 20% as we get a more profitable business here. Putting all that together, we get about a 4x return. We're getting up to £9 here. Probably about £9.50 would be a 4x return. This is my middle case. I'm getting really excited about this company. But you know what? Let's keep this excitement going. Let's get crazy here. Let's forget what we think will happen. Let's look at what we hope will happen. Growth, next 12 months. Who says we have to wait a few years for this growth to get up to 8%? Let's start us off at 8% now. The turnaround happens today. Historically, they have had plenty of years of double-digit growth. Let's have that continue. 15%. Let's lock that in. The market's going to go up 4.5%. Let's say they can beat the market. They've historically beaten the market for many years. They can continue doing it. I'll give them 5% terminal growth. Margins will start off similar to my medium case, but I'll have it get up there quite quickly. I'll get it up to 30% margins. Their goal is 25%. Let's say things go right. Let's say AI really puts a dent into those margins. We'll get up to 30%. Tax rate will keep the same. Return on invested capital with these much better margins 30% I think is very reasonable here as they turn into a much more of a subscription model rather than a bespoke people person service model. I get a valuation of over £24. That's about a 10x from here. A 10 bagger is potential, although I'm taking a lot of liberties with my assumptions here. So I think the returns could be very reasonably 4x, potentially going up to 10x. How much of this company have I bought? As you can see here, it still makes up a very small part of my portfolio. I have it about 20,000 euros worth. It's that tiny sliver in the pie chart here. That's because it's still early days. I've only been researching this company for 3 or 4 months at this point. I'm excited, sure, but I want to see more information. I want to see that next Investors Day, or I want to see the next earnings report, which will be out in around April, I believe. I want to see how they're going forward, and I will increase this. As you can see, I have a bit of cash burning a hole in my pocket, so I could very reasonably increase this up to 50,000, and then after another earnings report, I could probably go up to 100,000, although that might be getting a little high for me. Okay, I hope you enjoyed this video. If you want to see what I do in the future, subscribe. I'll try and keep you updated. Thank you for watching and have a great day.